Knowing what not to do when you start trading is going to put you on the front foot and in the best position to make profitable trades from the get-go. How's it going, guys? Ryan here with another episode of Stock Market Basics, and today we're talking about what not to do when you start trading, and in particular it's going to be my top 5 personal issues that I found I struggled with when I started trading myself. These may be different for everyone else, but for me, these were real influential factors that I really wish I knew about before I started trading. And before we get started, guys, please remember to like the video. It helps me out so much, and keep subscribed for more content. Leave any comments, questions, queries down below in the comments section. And with that, let's get into it. So number 1 is cutting your losses quickly, and this is fundamentally one of the biggest lessons that I've learned in my trading time, and this is due to the fact that you can really mitigate real big losses and impacts to your portfolio if you just cut those losses quickly. Time and time again, I see new traders, and myself, especially when I was a new trader, not cutting those losses quickly, and as a result, losing a lot more money than I had to lose. And this is really demoralizing for a lot of new traders out there, due to the fact that you don't want to be seeing your money going down. You don't want to be seeing your stocks in the red. You want to be making money consistently over time, and cutting your losses quickly is fundamental and should be a major part of your strategy when you're trying to trade. Coming in at number 2 is incorrect position sizing, and this is all to do with the number of shares that you purchase when you're going into a trade. And incorrect position sizing is effectively buying too many shares for the type of stock that you're buying into. So for instance, you may be buying into a stock which is not very liquid at all, and as a result there's not much buying and selling going on, meaning you can't exit that stock if you have a large position. For instance, if you see a stock trading probably under 1 million shares a day and you buy 1 million shares, it's going to be very hard for you to get out of that stock really quickly, especially if things start to turn sour, and as a result you either may A, not make as much money as you could have on a smaller trade, or B, you would take a much larger loss than you have to take. In general, when you are day trading, you want to avoid these sort of stocks anyway. If you're long-term investing, it's not too bad because you can sit and hold, and eventually they may become liquid stocks. But if you're day trading, what you're looking for is high volume, high turnover stocks where there is consistent amounts of buying and selling, and what you want to do is buy an appropriate position. So for instance, if it is a stock that turns over roughly 5 million shares a day, it would be appropriate to buy 50,000 shares as opposed to buying a few million shares where it's a lot harder to exit that stock. Effectively, what you're doing then is scaling your risk as well. Number 3 is trading emotionally, and this is something that's extremely hard to learn not to do because it really comes down to having a bit of experience within the market itself and ensuring you have an adequate trading strategy in place with the rules that prevent you from doing so. If you trade emotionally, effectively what you do is make rash decisions, and as a result you can either miss out on profits or lose significant amounts of money due to the fact that you are trading emotionally as opposed to with a rigid strategy in place. Often I see traders becoming impatient because they've taken a number of losses in a row, and as a result they start to take bigger and bigger risks to try and recoup that money. What you need to be looking out for as a trader is your individual trades. You don't want to be looking at the overall picture. You want to be focusing on your current trade, on your next trade then and there, and get the best bang for your buck out of it. What you don't want to do is go, oh, I've lost $1,000 over the past 5 trades. So in this trade, I'm going to risk a large amount of capital and as a result, potentially risk losing a lot more money than you could have as opposed to making that money back. You want to be looking for those consistent trades and allocating your risk respectively. As a result, you'll be in a better place going forward and more consistent in making profits over time. Coming in at number 4, and it's something that is extremely prevalent these days, and it's taking advice from people on social media or just people in general. You really don't want to be doing this, in particular if it's those people who are known to be stock promoters or people who are regularly in pump and dumps. At the end of the day, everyone's looking out for themselves, not others on the stock market. It's just a dog-eat-dog world type of situation. What you want to do is understand the techniques for trading yourself, both technical and fundamental, and make sure that you have your own strategy in place so that you can make your own informed decisions as opposed to taking advice from other people. Moving back to my previous point about trading emotionally, often social media and forums and these sort of sites can actually impact what you do when you're trading. You want to be able to block these out or just not use them at all when you're making your trades because you don't want to let them influence your decision based on the current knowledge you have. Coming in at number 5, and it's a big one that I always talk about, a lack of strategy and preparation in place before you enter a trade or just in general. You want to be going into a trade knowing your entry point, knowing your exit point, and knowing exactly what you're going to do no matter the way the price fluctuates. And as a result, having certain rules in place, having an overall trading strategy in place is going to better position you in order to make more calculated and more profitable trades over time and also minimize those losses. This point essentially sums up absolutely everything we talk about when we're coming to trading. Having that strategy is absolutely fundamental. Furthermore, it's extremely beneficial to understand what's currently going on the global markets and in the news itself, because these factors will have an impact on the shares you're trading and will have an impact on your strategy, in particular your pre-market strategy, where you're looking at different stocks and determining where you could potentially make a good trade. Keep up to date on these things. Make sure you're checking the news every day, the futures, the commodity prices if you're trading in materials, or general bits and bobs going on within each of the retrospective markets, and you'll be placed significantly better than you would be if you didn't know what's going on. At the end of the day, a stock can have absolutely everything going for it, but then if something happens on the global scale that impacts every single stock or every single stock exchange, then effectively the stock's going down or potentially up if it's a good thing. No matter what, it has nothing to do with the individual stock you're invested in itself. It comes down to the macroeconomics of the situation. And that wraps up today's video, guys. Hope you enjoyed it. That's my top 5 common mistakes to avoid when you start trading on the stock market. Leave yours down below. It's really interesting to see what different people struggle with and what they've had to overcome in their stock market journey themselves. As always, guys, please remember to like the video. It helps me out so much. And please subscribe for more content if you haven't done that yet. And with that, guys, I hope you have an awesome day. See you next time.